Hey, good morning, everybody. Mike here, back up, get myself all situated. All right, good. All right, coming in loud and clear. That's nice. Got the purple background going. Yeah, we're having an ugly morning again. This is bear market time, folks. So let me go ahead and share my screen with you, make sure that we are all on the same page here. And it's not just crypto. Everything kind of took a big drop and dump today. Some more than others, but we'll get to that in just a second. Okay, so let me make sure I can see everybody's chat. Yes. All right, cool. Yeah, so really everything is kind of down today. And I was trying to figure out what happened. So Bitcoin's down 0.2%, but it hit 68 grand. Now we're under 66, and everything could just kind of nuked really quickly. In fact, not really sure what caused this. In fact, if we go into the 1 hour chart, everything really around this time started nuking. In fact, silver just like immediately slammed down at 10% actually earlier. Gold immediately down. I mean, if we zoom in, we can kind of see that on the last hour, it all just kind of went haywire. So, um, gold down, silver down, copper down, palladium down, platinum down. I've been looking at these, just kind of checking them out. S&P 500 immediately down, Nasdaq instantly down, Bitcoin down, alts down. So, Microsoft down. Everybody just kind of dropped today, and I'm not exactly sure why or what exactly happened there. Of course, MicroStrategy down, Google slightly up. Actually, the only thing really on the leaderboard for the most part that's up. So not quite sure what's happening there, but overall a bit of a mixed day. Still kind of red from yesterday. Just for sentiment, let's take a quick temperature in the room. This is the lowest I've ever seen this metric ever. As a matter of fact, we are in fear and greed that I've never seen hit before. So, from a Bitcoin fear and greed standpoint, I think this is the lowest I've ever seen. In fact, I pulled this up. They've been keeping track of this since February 1st of 2018. So, we've now gone through two full bear cycles. And the only time we might have equally ticked this, I think we might have hit a five or maybe a six. I still think this was a six, but for some reason, this thing is kind of crappy in that it doesn't let me zoom in to this metric right here. This was in the summer of 2019. And that's after we had, the bottom in 2018 at 3K. And then we ramped to 14,000 by June. And everybody thought, yes, we are back straight to new all-time highs. And then we just collapsed. And that was about the lowest the fear's ever been. We had a slight detour. This wasn't even this fearful during COVID. I mean, we were close. We were down to, 9, 10, but we weren't this fearful. And keep in mind, Bitcoin got cut in half in a day. I think it was like 51% in one day, in 24 hours. So we are into levels of super fear that I have not seen in a long time. Even at the very bottom of the collapse, it wasn't the exact bottom in price, but the volume in 2022 in the summer, that's after China had banned Bitcoin, we got down to a low of, I think, like 8 back then. And that was after Bitcoin had gotten to 61,000 and then fell to 30 inside of like a couple weeks. So total collapse in the price there. But now here we are. Bitcoin's at about a 50, well, let's just easy math. It's a little under 50% down from the all-time highs, and we are at fear and greed 5. So that's crazy talk. So let's talk about last week and what happened. Because if we look at, let me go back to my Bitcoin chart here. If we look at what happened last week, on our call, it's last Thursday, it tanked, right? So last time we were in the 70s, low 70s during our call. On the 6th last time, I think that was it, maybe 6, somewhere in there. But yeah, we eventually ended up wicking on Friday all the way down. You can see this total capitulation wick all the way down to like 59,000. So we broke under 60 just barely. 59, 900, basically. Wicked all the way down, blasted back up to 71, almost 72, and then we've just been kind of slowly falling and trending back downwards. So usually if this was the low, and I don't know, maybe it's just because the fear and greed is at 5 and I'm kind of feeling the same way. I would be hesitant to try to catch a falling knife here. I think we need to just wait it out, because after that kind of capitulation, either one of two things is going to happen. This is going to be a quick fake out, and then we're just going to grind slower, retest the 60, and then blast down through it. Or we're just going to grind sideways for a little while, give a little false hope, push up to like, 76 or 80 grand, something like that, right before all this, maybe not that, but somewhere here before all this collapse happened, just to fake everybody out, then we do the final nuke. So I'm still in a bear mindset. But let's talk about what happened because that was a crazy drop last Thursday. I mean, it was violent. So this was from that Thursday a week ago. And just the sheer volume of this is worth covering. So $380 billion wiped out in market cap as $2.6 billion in liquidations pushed Bitcoin to 60K. So that was huge. That was one of the, I think, the top 10 liquidations of all time and massive. So this is again from last Friday or last Thursday. Bitcoin price recorded one of its sharpest single day declines in recent years, a move not seen since the FTX collapse. Ethereum, it dropped to 60. Ethereum dropped to 1800, while Solana broke under 70 since the first time since December 23. Top reasons why it dropped. Number one, and remember what I was talking about this a while ago. Once we slipped, I said if this falls below 100 grand, it's going to get ugly. And absolutely, that magical 6-digit number had some magical incantation there. And sentiment, once it broke 100, it just didn't really come back. So massive long liquidations took control. The liquidations repeatedly crossing 1.5 over $2 billion. The latest sell-off was especially brutal, wiping out over 1.85 billion in long positions, making it the second largest liquidation event of this year after the $2.4 billion flush seen on January 31st. I think it actually got pretty close to 2.3. More than 500,000 traders were forced out of their positions as the leverage unraveled across exchanges. Here in a bit, I'm going to talk about how Bitcoin has kind of shifted from caring about inflation and the interest rates and more about overall liquidity across exchanges, not just in the economy, not M2 money supply. So Bitcoin dropped below key technical support then. Once it slipped below 62, stop loss orders clustered in this region were triggered rapidly. This led to a sharp increase in sell pressure, basically nuked us down to 60. Bitcoin lost support at both the 50-day and the 100-day moving averages. So weak dip buying at key levels, which is why buyers have stepped back. So usually it was how quietly the buyers stepped back in. When the price fell through the 65 to 62 zone, there was no strong rush to buy the dip, unlike earlier pullbacks. So all of that was kind of what caused this to happen. So let's start with the ugly stuff. Then we'll get to the positive outlook. How about that? So this is kind of, I think, one of the more important things today. There's a bit of a difference between this and previous cycles. And I thought this was interesting. So crypto markets won't fly without more credit. So what does this mean? Beneath all this progress of all the things that have been going right with crypto in terms of passing legislation, maturity, ETFs, banks can now carry it, all that stuff. This was interesting. So beneath all this progress lie deeper structural issues in the crypto market that more US regulation won't solve. The October 2025 market correction clearly revealed liquidity issues, which are still prevalent today. So if you remember on the Binance liquidity thing on October 10th, it was the biggest liquidation, I think, of all time, reportedly up to 20 billion. So that's crazy, right? This past thing that nuked us to 60 was 2.3 billion. So this is almost 10 times bigger, almost an order of magnitude larger. So while they're not causing the current crash, illiquidity hampers market stability. A shortage of crypto credit and prime brokerage are directly contributing to crypto's liquidity droughts. If the industry does not create more crypto credit, an artificial ceiling will be placed on crypto. So this doesn't mean like making crypto out of thin air. This just means putting more liquidity into the system. We'll talk about this here. So the October 10th, 2025 correction itself was not unusual. What was more revealing at how quickly liquidity evaporated and how slowly it has, or in this case hasn't, returned. So, that's really not good. We want to see more liquidity. Yet liquidity in these markets, in the other markets like financial markets, equities, bonds, foreign exchange, they also had a liquidity crunch, but those recovered really quickly in terms of liquidity, whereas crypto has not. So this is a structural, not a cyclical issue. The same cannot be said for crypto. Not only did liquidity dry up in the aftermath of October 10th, but it remained thin months later as sellers struggled to find buyers. So it seemed like the October 10th liquidation probably blew up some market makers and really, really hurt them. So they've been very, very shy to get back in the game. Thus, we have very illiquid markets in crypto specifically, whereas stocks, precious metals that are much larger still have plenty of liquidity. So one of the principal constraints is a shortage of credit. In crypto, trades are mostly pre-funded, and the use of leverage for market making is small. When volatility spikes, capital is quickly withdrawn and spreads widen dramatically. The absence of a sustainable, transparent credit mechanism leaves the market brittle at precisely the moments when liquidity is most critical. So this is very different than traditional markets. These guys have tremendous amounts of credit uh, and liquidity, right? Crypto just still doesn't have that yet. So better access to credit is the next essential step. In FX, for example, market makers can become risk takers temporarily, supported by credit lines from prime brokerages that allow them to continue quoting prices to liquidity takers even during periods of high stress. In other words, credit fuels market activity, but crypto doesn't have this. And as crypto becomes bigger and becomes more financialized and becomes, people are using more leverage, it's impeccable, really, really crucial that crypto apparently gets more liquidity, in this case, needing more credit. So more crypto prime brokerage is essential, and current regulation constrains how investment banks engage in crypto markets. The capacity of banks to hold and finance crypto exposure is limited by Basel III and the prudential rules around crypto assets, which impose high capital requirements. So, even if a more favorable US administration loosens these rules, conditions will remain challenging, so they need to make some big differences here. Crypto market needs a resilient and broad layer of crypto prime brokerage with more credit provisions if liquidity conditions are to improve. More crypto credit would substantially improve liquidity, and market makers and investors do not need to wholly pre-fund trades. That can be used more dynamically instead of being locked up, which is a big issue. At the same time, prime brokerages enable netting between counterparties, which frees up capital for more trading. Crucially, broader provision of credit allows more institutional firms to directly participate in spot crypto markets, bringing much needed participants to deepen trading and liquidity. So I think this is something that David Sachs, our crypto and AI czar in the United States government, is very well aware of. So I'll have to check in on his X feed and see if he's aware of these things and what he's doing to possibly suggest new structural changes there. So moving on a bit is it's kind of interesting, for the last 4 years under the previous administration, we had basically had an SEC that was hell-bent on just freezing and then trying to destroy the crypto market. I don't think that's an over-exaggeration. I think that never putting out guidelines and just suing the hell out of anybody when they stepped over some imaginary line that wasn't clear at all, outright refusing to meet with crypto companies no matter how many times they requested an audience, and then publicly saying, hey, all you have to do is follow the rules. You just have to come in and visit with us. Okay, when can I come visit with you? Silence. Anyway, I thought this was just disappointing to see that crypto has absolutely, much to my chagrin, become a partisan issue like everything in the entire world now. Everything is blue-red, everything's left-right, everything is really stupid that way. So Democratic lawmakers slammed the SEC Chairman Atkins over crypto enforcement. The Democrats do not apparently like crypto. They don't like how it's being handled. Some, they have very valid criticisms, which I'll get to in a second, but some are just complete nonsense. So enforcement actions since President Trump assumed office and appointed Atkins are down by 60%, Representative Stephen Lynch said, as if this is a bad thing. We're not regulating this industry as hard. It's like, well, you shouldn't have been regulating it this hard in the first place. So I think this is a fantastic thing that enforcement actions, which means we're going to sue you for some perceived, bullshit, are down 60%. That's a huge win. The Massachusetts Democrats cited the dismissal of several SEC lawsuits against the crypto industry, including the SEC's motion to dismiss the Binance case in May 2025 as example of the dropped enforcement cases. He's thinking that this is like, see, you should have been pursuing these, but it's a good thing that those were dropped because they were bullshit. Lynch also said that foreign investments in World Liberty Financial, a decentralized finance platform linked to the Trump family, and meme coins launched by the family are also causes for concern. That I 100% agree with. I think that the World Liberty Financial is, I don't like that at all. In fact, this specifically, recent reports indicate that REM Investment One, an Abu Dhabi investment vehicle backed by the Sheikh bin Zayed Al Nahyan, the national security advisor of the United Arab Emirates, purchased 49% of the startup behind the Trump decentralized finance project. I don't like that. I don't like that at all. I think that they probably need to divest themselves out of that project. Everybody threw an absolute fit when Hunter Biden was selling paintings for $500,000 to peddle influence. And, now on the right, it's like complete silence when Abu Dhabi owns basically half of a Trump crypto startup. So yeah, I think that's a bit concerning to me. And I think that that's very valid for criticism. So the comments come during the U.S. midterm election year and could signal a resistance towards crypto from the Democrats. I think that's clear, which could stall, here's the important part for us, market structure legislation if the Democratic Party takes back control of at least one chamber of commerce. So of Congress, excuse me. So it's just disappointing that this has become a left-right thing rather than a, you know, American freedom, American innovation thing, which is what it should be. And then Rep. Maxine Waters claims crypto industry pardons dropped lawsuits are politically motivated. Disagree 100% here. Quote, these cases were dismissed despite the fact that the SEC was winning in court, proving that the SEC's enforcement program was well grounded in law. I don't know that I would say that they were winning in court. I would say these things have been dragging on for years, wasting everyone's money to the tune of hundreds of millions of dollars for startups in companies like Coinbase, which have to spend nine figures defending themselves in court. So it's just disappointing this has become a predictable left-right thing when it really shouldn't be. And how long until AI becomes a left-right thing too? And everything, breathing air becomes a left-right thing. It's just disappointing. Anyway, that's enough of that. Let's talk Bitcoin. So Bitcoin futures data shows the bears are gearing up for an assault on 60K again. So will we hit that? More than likely, in my opinion. Unless proven otherwise, we're in a bear market, and I think that the targets of anywhere from 38 to 50 grand as a downside by Q4. I think that's still fair as far as a target, unless proven otherwise. But so far, this is playing out just like all the other crypto bear markets. So Bitcoin price fell to 65,800 on Wednesday, slipping back below key intraday trend lines and raising concerns that last week's drop to 60 grand might not have been the final bottom. So the RSI index is trending toward oversold levels as prices trade below key moving averages. Liquidation heat map indicated an absence of liquidity up to 60,500, keeping the risk of a downside price move open. Right now we're at 65.7, so yeah, we're still kind of under that 66 level. So the failure to hold 70 grand when we ramped back up weakens Bitcoin's short-term prospects. So, we had this big move back up from 60 to 71, 72. It failed again. And so that's kind of now our overhead resistance. So price briefly pushed into intraday highs of 69,800 before reversing sharply during the New York session yesterday, forming a classic swing failure pattern. Also traded below the 50 and 100 period exponential moving averages, confirming short-term bearish control. 15-minute order block. Strong buying pressure stepped in after Bitcoin printed a yearly bottom of 59,800, which is still just crazy to me to think that we dipped below 60 when just feels like a handful of weeks ago or a month ago we were at 100. This region remains a liquidity target of 64K, fails to hold. 60 grand is a liquidity magnet. People stepped in size. So we have stacked orders above 72, but also highlights a liquidity void from 66 to 60,500. So liquidity void may act as a magnet. Basically, again, lack of liquidity here. It means that if we slice through 66, then, which we're under right now, we could just zip straight back down to 60 grand again. So the overall market structure, with the overall market structure starting to weaken, a lack of swift recovery above 68 increases the risk of further downside towards lower support levels near 65,000. But so far, it's expected to trade within a broad 60 to 72 range. We'll have to see. In fact, I was looking at not Trueflation. I was looking at Polymarket. There we go. And I'd be interested to see if this has changed since this morning's drop. Yeah, actually it has substantially. So this morning is quite a bit. So what price will Bitcoin hit in February? Earlier on today, the odds were actually much higher at 75,000. Now they've dropped to a 50% chance of it hitting 60 again. So that's actually quite a bit different from when I checked earlier. So that's not what we want to see. Also, if we look at this before I refresh the screen, there's a 28% chance of hitting 72 before 64. And now if I refresh this, quite the opposite. 61% chance of hitting 64 because we're so much closer. That's not looking great. And then lastly, same thing with Solana. Solana had I guess the highest thing at 60. That's probably still going to be there. Yeah, same thing. Okay, and then we'll talk about this here in a short minute, but yep, probably going to get another government shutdown, 96% chance by Valentine's Day. This is our dysfunctional government. This is how bad our funding is right now, is that, every month or two we run out of money and the lights turn off. So this is basically crazy to me that we're here. So let's continue on here. So this is also important when we talk about liquidity. This is going to drive a lot of us and when we'll be able to tell when things turn around. Why Bitcoin's recently reacted more to liquidity conditions than rate cuts. So Bitcoin now responds more to liquidity than rate cuts. While rates once drove crypto rallies, Bitcoin's recent price action reflects actual cash availability and risk capital in the system, not just borrowing costs. Interest rates and liquidity are not the same. Rates measure the price of money, while liquidity reflects the amount of money circulating. So the price of dollars versus the amount of dollars. Bitcoin reacts more tightly or more now when liquidity tightens or loosens, even if the rates move in the opposite direction. So this is kind of something that has really shifted this cycle. So the classic link between Fed rate cuts and Bitcoin trading has weakened in recent months. Bitcoin now responds more to actual liquidity levels, like we were talking about, in the financial system than to expectations or incremental change in borrowing costs. So this article will clarify that anticipated rate cuts have not pushed up Bitcoin recently. So why don't the rate cuts really they don't affect it as much anymore? Why is that? Well, there's heavy pre-pricing. Markets and futures often anticipate cuts well in advance. Context matters. Cuts driven by economic stress or financial instability can coincide with de-risking. And then lastly, cuts do not guarantee liquidity. That's the big one. Ongoing balance sheet runoffs, large treasury issuance, or treasury reserve drains can keep the system constrained. So it's almost like having less oil in a system. The less oil in the system, the more friction there is. The more friction there is, the more we get these huge liquidations because people are still playing with crazy amounts of leverage. So Bitcoin is as a liquidity sensitive high beta asset. So Bitcoin buyers rely on leverage, available risk capital, and overall market conditions. This dynamic suggests that Bitcoin behaves less like a policy trade or policy rate trade and more like a real-time gauge of liquidity conditions. When cash becomes scarce, Bitcoin tends to fall in tandem with equities and commodities regardless of the funds rate. So that's kind of changed quite a bit. So what lies behind this liquidity? And what can we start looking at to see when liquidity will turn around for possibly marking a bottom? Well, one is the Fed balance sheet. Quantitative tightening shrinks the Fed's holdings and pulls reserves from banks, meaning there's less dollars in circulation. While markets can handle early QT, it eventually constrains risk taking. Two, Treasury cash management. The U.S. Treasury's balance sheet acts as a liquidity valve. So if they're expanding their cash management, that's good. If they're contracting, it's bad. And then money market tools, facilities like overnight reverse repo absorb or release cash. And they've been, if I remember correctly, shrinking this as well. So here's something. Did you know some of Bitcoin's sharpest intraday moves have occurred on days when with no Fed announcements at all, but coincided with large treasury settlements that quietly drain cash from the banking system. So this is signal in all the noise. So we'll keep a more close look at that moving forward. And then why the recent sell-offs felt macro and not crypto specifically. Lately, Bitcoin drawdowns have aligned with declines in equities and metals, pointing to broad liquidity stress as a whole, rather than just crypto issues. Now, granted, as we know, crypto moves faster and further than anything, right? So the stock market's not down roughly 50% like Bitcoin is, right? Or even more for altcoins because there's more liquidity and so on, but they've also sold off their tops for a lot of these. So the liquidity surprises pack a much bigger punch. Liquidity shifts are less predictable and transparent, and markets are not as adept at anticipating them. So how to think about Bitcoin's macro sensitivity. In the current regime, liquidity sets the near-term boundaries for risk appetite. And the things we'll start having to look forward to, but look out for: central bank balance sheet signals, treasury cash flows, and treasury general account levels, and then stress or easing signals in monetary markets. And overall, the broader shift here, which is different. Again, the market keeps updating. We've been in this now for 8 years with Moonstream, long time, multiple cycles, and every cycle has been a little different as the market has matured. So Bitcoin was long seen as a hedge against currency debasement. Today, it's increasingly viewed as a real-time indicator of financial conditions. When liquidity expands, Bitcoin benefits. When liquidity tightens, Bitcoin tends to feel the pain early before other asset classes. So one thing that could help us overall, and I don't think it would be like an instant run back to 126 grand if it's passed, but it certainly won't hurt anything, is if we can get this damn crypto bill across the table. But the banks have just dug in. They do not want to allow any competition. Quote, productive session at the White House today. Compromises are in the air. Ripple's chief legal expert, Stuart Alderalty, one of the meetings said, posted on X on Tuesday. Clear bipartisan momentum remains behind a sensible crypto market structure legislation. We should move now while the window is still open, he added. The problem is the banks. Bankers and crypto flag need for more discussions. Dan Spiller, industry affairs lead at crypto advocacy group Blockchain Association, posted on X. The last meeting was a smaller, more focused session with serious problem solving. Quote, stable rewards were front and center, he said. Banks did not come to negotiate from the bill text. Instead, arriving with broad prohibitive principles which remain a key disagreement. So instead of negotiating, they're going, here's our list of demands, screw you. And apparently the Democrats, and again, this is not a left-right thing. I'm calling balls and strikes here. I have no loyalty to either place. There's my disclaimer. Democrats are backing the banks on this one because the Republicans are all for getting this thing across the bill, across the goal line. So it must be Democrats who are siding with the banks on this because the banks don't want competition because their fear, rightfully so, and it should be a fear because that's what competition is in a free market. If you don't adapt, you die. Tough shit. And if a stablecoin company, in fact, the stable bill already said, in fact, I'm going to quote someone else because I'm just going to rehash what they said. Added that, quote, a framework can and must embrace financial innovation without undermining safety and soundness. And here's what the bank said: without putting the bank deposits that fuel local lending and drive economic activity at risk. So their fear is if stablecoins can offer interest. And to clarify, it's not that if you own Tether and have it in your own wallet, there's going to airdrop interest to you. That was already a no-go with the Stable Bill Act. That's already been done. The thing the banks are fighting is if you have Tether or USDC on your Coinbase account, your Kraken account, whatever, that if you take certain actions, you trade a certain amount, you do this, do that, then as a reward, they can drop some Tether into your wallet, just like you could with credit card reward points or whatever. And they're fighting that too, because any entrenchment upon their little regional bank things is going to suck up billions of dollars out of local banks because you could earn a lot more with your crypto exchange. And it should be that way. They need to compete or die. They need to adopt stablecoins instead of old business that's been that way for 100 years. Meanwhile, BitGo CEO Mike Belshi said that both crypto and banks, quote, should stop relitigating the Genius Act, which banned stablecoin issuers from paying yield directly to get the market structure bill across the line. So they're still fighting this because it's existential, because they just either A, refuse to, or B, simply won't compete. They're just dug in on the old way of doing business and they're trying to use the law to stifle competition. And that's just what happens, just like the taxi lobbies did with Uber, so on and so forth. Okay, moving on. Chainlink co-founders, two reasons this bear market feels different. There's been no major FTX-style collapses, and tokenized real-world assets growth remains substantial. So this is kind of interesting. We haven't really talked about real-world assets being tokenized in quite a while. Crypto market cap has fallen 44% from its October all-time high, with almost $2 trillion exiting in just the last 4 months. Unlike the previous cycles, such as the FTX and crypto lending failures in 2022, remember, FTX blew up, BlockFi blew up, God, who are the other ones? Genesis, maybe? I can't remember. A whole bunch of these guys all blew up. There haven't been major institutional collapses during this drawdown, indicating that the industry can now handle volatility more reliably. Now, real-world asset growth will drive institutions and infrastructure. So, secondly, RWA tokenization and on-chain perpetual contracts for traditional commodities will continue accelerating regardless of crypto prices, proving this innovation has standalone value beyond speculation. Check this out. Tokenized real-world assets on-chain value has increased 300% over the last 12 months. Look at this. It's just up and to the right. More and more and more and more real-world assets just keep getting tokenized. Now, the thing is, here's the important part. This signals that having real-world assets on-chain, quote, is not tightly coupled to cryptocurrency prices, but provides its own unique value that can grow irrespective of market pricing of Bitcoin or other crypto assets. So, for example, this is, again, from Chainlink. Chainlink, even though more real-world assets are going on-chain, theirs hasn't increased in price either. So on-chain perps and tokenization offer unique value such as 24/7 markets, on-chain collateral, and real-time data, which is growing steadily. Quote from the Chainlink co-founder, if these trends continue, I believe what I've been saying for years will happen. On-chain real-world assets will surpass cryptocurrency in the total value in our industry. And what our industry is about will fundamentally change. And of course, this is going to be true, right? It doesn't mean that people will use crypto less. It just means that, if you're going to take $1 trillion worth of real estate and tokenize it instead of using a title or a deed, then yeah, of course, that's going to end up being a much larger market cap than, let's say, Bitcoin, because there's just more real estate out there than there is Bitcoin value. Now, Bernstein analyst, I'm not going to attempt that name, Katam, echoed the sentiment in a note on Monday, writing that we're experiencing, quote, the weakest Bitcoin bear case in history. Not the weakest bear market in history, but the bear case. The current Bitcoin price is a mere crisis of confidence. Nothing broke. No skeletons will show up. Basically, this time we don't have big, giant, lending firms exploding. We don't have Terra Luna exploding. We don't have FTX exploding. Now, with that said, we don't know if any of these treasury companies could explode. So that's one fear that's still in the back. Jeff May, chief operating officer at the BTSE exchange, told Cointelegraph that this sell-off is different in that it was caused largely by non-crypto catalysts. Those include fears that faltering AI tech boom could cause stocks to crash. Believe me, I'm sure you're probably hearing that narrative as well. Compounded by the appointment of Kevin Warsh as Fed chair, who many believe will reduce liquidity in the financial system. So, we can go back and look and see right about there, if I remember correctly, right at 91,000. That's when Trump appointed the Fed chair, Kevin Warsh, and the market just nuked. We'd just been going sideways. Fed chair appointed, and oh God, it's all over. Nuke, right? All the way down. So that's worth looking at because everybody at this point is kind of aware that it's all about liquidity. And if he is going to be hawkish, which he has kind of publicly been in his stances and not give us as many rate cuts, then that could be bad for us. What is good for it means that we could probably get the US back on track because he's not a complete jackass like Jerome Powell. Not because Jerome Powell hasn't been doing what Trump wants, but rather that Jerome Powell let inflation get so far out of control before he finally took action. And when he did take action, he did it far too much and for far too long. And then he was also now taking far too long to cut rates. So he's just running so far behind. And they don't seem to understand that AI is the ultimate deflationary tool that we really risk some bad stuff happening if the Fed doesn't cut a lot, because deflation is really the bigger risk now than inflation.